Joining us now, former IMF chief economist Ken Rogoff, an economics professor at Harvard now, and former Fed economist Julia Coronado, the founder of Macro Policy Perspectives. Welcome to both of you. And Ken, do you think they should hike or pause here?
It's a knife-edge call. I probably think if it was right today, they should still hike by a quarter point. But, obviously they can say, well, we're going to wait and do more later. You could call it either way.
Which would be kind of a hawkish pause, as Steve Leisman has said, could be one option on the table. Ken, talk about the contagion risk here. Do you see it? Have authorities stopped the problem in its tracks?
Not at all. I mean, I think that we're in a world where inflation's higher, real interest rates are higher, China's not going to be the growth force that it was. It's not easy to have a soft landing here. It's just surprising something hasn't happened earlier. So I think they did a good job in preventing bank runs, and credit both what the Swiss National Bank did and what the Fed did. But, they can't necessarily fix the deeper problem in some banks' books. And it's not just banks and the economy more broadly. We're in a situation where things are going to break.
Ken, I'm trying to figure this out in my head. If you guarantee all the deposits and explicitly, implicitly, whatever it's going to be, is there a way to therefore regulate it on the other end? And do you think that there's the political will to regulate it on the other end at the smaller and regional community banks and the like, and to do it in a way that doesn't cost those banks their livelihood, frankly, in the end, but not create this sort of moral hazard about the kind of risks that everybody would therefore take?
I think the answer to that is
they're in a really hard place.
Go ahead, Julia.
I think the answer to that is yes, that, right now you can be sure that all the regional feds are checking in with the banks that they supervise, having conversations about the stability of their deposit base, the hedging strategy for their portfolio. We're not talking about, a credit problem broadly. I think with Silicon Valley and tech-facing banks, that's a different story. But with most banks, this is just about, book value, market value losses in their held-to-maturity portfolio. That's a manageable problem with liquidity and supervision, I think. That doesn't prevent, I think, as Ken noted, a broader contagion just through tighter bank credit. That's an inevitable outcome of this. That's sort of the nonlinear part of monetary policy tightening that's shown up with a lag. So I think that's yeah.
Just to kind of clarify, do you then think they should pause next week?
No, I mean, look, I think given the positive market reaction to the Swiss National Bank's actions, if markets, and that's a big if they remain reasonably calm over the next several days, I think it would actually be reassuring for them to move ahead with a 25, not a 50, a 25 basis point rate hike, which is kind of a sense of normalcy. They know that they need to get rates higher. The data have certainly been telling them that that's the direction of travel still. So I think it would actually be potentially more confidence enhancing than a panicked pause.